Thought leadership from PwC's National Office.
Hello, I'm Heather Horn, the host of Sustainability Now, and thanks so much for joining us today. One note before we jump into today's episode. We recorded this prior to February 26, 2025, when the European Commission released its first omnibus package of proposals to, quote, provide substantial simplification in the field of sustainability and EU investment programs, end quote. For more on these proposals, please look for an upcoming episode, and we've also linked a number of resources in the show notes. In the meantime, these proposals are draft and subject to change through the adoption process. So in today's episode, we'll continue to focus on the currently enacted requirements. With that, let's jump into the recording. Hello, and welcome to PwC's Accounting Podcast Series. I'm Heather Horn, PwC US Sustainability Technical Leader, and I'm so happy you're joining us today. Today's episode is planned as the final episode. Who knows, we may do a few more bonus episodes in our video podcast series on sustainability reporting. And as I said, this in a way is a bonus episode because we're actually going to hit some frequently asked questions about GHG emissions reporting. So those of you who are regular listeners will know that last fall we did an entire series on GHG emissions reporting. So if you need the basics, I highly encourage you to go back to that. And then even last week, we did a compendium of information giving you a lot of the highlights in reporting. However, we have been getting so many questions as companies get into practical implementation, particularly for companies that are first-time adopters of ESRS, the European Sustainability Reporting Standards, for companies reporting in the EU under the Corporate Sustainability Reporting Directive. So, my guest, Marcin Olowinski, and I thought that we would bring you some frequently asked questions in GHG emissions. And not that Marcin needs a big introduction, but just in case, as a reminder, Marcin is a specialist in our national office focused on GHG reporting and the chair of our GHG Global Working Group and serving clients in the sustainability working space and one of the lead authors of SRG 7 Sustainability Guide, a reporting guide on GHG, and probably more. Do you want to add any more accomplishments, Marcin, or is that enough?
I'm also serving multiple clients.
There you go. Thank you. Although I think I said that, so you weren't listening to me. All right. So with that, now we'll get into good stuff. So as I said, Marcin, we obviously have covered a lot of the basics. So for listeners that have not listened to some of the basics or don't know the basics, this episode may seem to jump around a lot because we are going to jump into different topics, but I think they're great ones because they're all the ones that we've been getting questions on. So I'm going to start with the starting point, organizational boundaries. And I know, ESRS has unique rules for organizational boundaries for people that are used to preparing their organizational boundaries under the GHG Protocol. And we continue to get a lot of questions there. So what are some of the areas we're getting questions on?
I think it's, you're absolutely correct. And I think we're receiving questions because of the nature of ESRS guidance in this area. So as a reminder, and I know we might have a mixed audience, so the uniqueness of ESRS organizational boundary guidance is two-step approach. So the first, companies have to consider reporting emissions from subsidiaries fully consolidated in financial statements. And then for all the unconsolidated subsidiaries, joint ventures, and other type of arrangements, you have to consider operational control. And if you have operational control, you have to report also 100% of Scope 1, 2, and relevant Scope 3 emissions. Why it is kind of creating problems? Because a lot of our clients have experience reporting emissions. Usually they're doing this using one or the other. So,
well, that's what's permitted under the GHG Protocol.
Yes, exactly. So, which means they might not be fully familiar with the concept of the other approach that they don't. So, therefore, we start having the questions about how you approach those, what is the practical difference between the two, and we start having more specific kind of application questions in various areas. And today, I'm going to just, as an example, to illustrate, focus on two of them, leases and investment company accounting for emissions from the investees. Again, this is not overarching issues, but as an example of what type of questions we're getting. and what does it mean for practical application, right?
Yeah, and I think a key point there, Marcin, and this is something Diana and I talked about earlier in the series when we're talking about reporting boundaries more broadly, is that the reporting boundaries or organizational boundaries for GHG apply to entities, assets, and operations. And again, this may apply in the financial statements, but we don't think of it the same way. And that's where I think leased assets comes in. It's in the assets category of these entities, assets, and operations. So with that said, again, as a reminder to listeners, ESRS, that we are talking about ESRS here. So this will not apply if you are talking about GHG protocol or reporting under ISSB. But what are the issues under ESRS?
Quite frankly, the issues with lease accounting under ESRS are connected to the problems of GHG protocol. So as a reminder, I'm going to do it as a starter. So GHG protocol has a specific model to account for leases, which depends on the type of a lease and organizational boundaries selected, right? So that's a starting point. In general, the operational control is assumed to be held by lessee, who's considered to be operator of leased assets. The problem begins with the fact that GHG protocol did not update its guidance to reflect the changes in accounting or financial reporting of leases. So the guidance is based on old lease accounting pronouncements under IFRS on the US GAAP. And as we all know, the IFRS and US GAAP changed accounting for leases quite substantively. In particular, under new guidance, all lessees have to record right-of-use assets that relates to the lease arrangements they have. So now, historically, only certain type of leases resulted with booking out recording of the assets. Now, all lease types result in recording of right-of-use assets by lessee on a balance sheet, which is quite significant change, right? So we're getting questions from clients. Okay, what does it mean for my reporting under ESRSs? And it's kind of a complicated issue, and it diverges from historical practice, because when you think about it, the two-step approach, first part of the approach is reporting emissions from assets that are fully consolidated in financial statements of reporting entity. So the question is, okay, now I have a right-of-use assets, which we already published the position, lessee should report emissions from scope 1, 2, and a respective part of scope 3 from right-of-use assets, which creates certain issue.
Yeah. Well, yeah, I just want to pause this there, though, because I think for us, you can go pretty fast through this because we've been through it so many times. We talked about this for months and months. But let's pause a bit on lessees. So again, what you said under the GHG protocol, the historical model, the unupdated model, is that you would base everything on operational control. And then there's some differences. And even under the GHG protocol, we think that you may need to make some changes to how you're reporting emissions under the new guidance. But now, under ESRS, those assets, you have the right of use asset on your balance sheet. And so it is in your financial control and operational control across the board for lessees. Is that what we're saying?
Yeah. So like it's under two steps. Even if you conclude somehow that you don't have to do it for right of use asset, then you have to assess operational control. As I said before, lessee is presumed to have operational control of all these assets, right? So whichever way or direction you take, you're always going to end up, lessee has to be reporting scope 1, 2, and 3 emissions associated with leased assets. Right?
Okay, so that's easy. I'm the lessee, I report. All right, so now lessor.
Well, so that creates certain problem for lessors, right? Because lessors, depending on a type of lease, you can have two scenarios. Either you retain the physical asset on your balance sheet, like as nothing happened, let's say, so it's part of your fixed assets, or you can have situations whereby in certain types of leases, you can remove or de-recognize this physical asset and recognize like lease receivable, right, on your balance sheet. So now, depending on which scenario you are, if you continue to report physical assets under ESRSs, based on our interpretation, you have to be reporting scope 1 and 2 emissions because this asset is fully consolidated on your balance sheet, right? Yes. When you don't have that asset, but you have a lease receivable, we think it's akin to like a loan or finance emission, and a lessor could be reporting scope 3 category 15 or, actually no, that's
Category 11.
Category 11. Well, not 11.
Yes. 13.
13.
Yes.
Category 13.
Okay, third time's the charm.
Yeah, downstream leases, right? So, but the first part is that's where it's a little bit problematic under ESRS, because what you're gonna end up having is two parties might be reporting the same emissions, because you have two types of you have assets related to leases recorded on your consolidated financial statements, which is a little bit contradictory to historical practice under the GHG Protocol, which presume only one party is gonna report those emissions. So that's why our clients are a little bit uneasy. Well, I'm going to have a double counting in there. We think it's fully supportable, first of all, because of a change of accounting model for leases. Second of all, in our opinion, the ESRS two-step approach presumes that situations, not only for leases, also for unconsolidated investments, it was designed to potentially requiring two separate parties report the same emission.
So, Martin, one thing I want to pick up on what you just described, because as you were walking through the model, you mentioned fully supportable. And I think sometimes that gives a context of it's something people want to do. And is it okay in the guidance? And I mean, I think in this case, when we read the guidance in ESRS, this is what it says that lessors should do because they have the asset on the books. In the scenario where it's not a finance receivable, they should be reporting scope 1 and scope 2 emissions. However, I know that this has been an ongoing discussion because there is some concern from lessors. Is this really the model that was intended? And so can you just give sort of an update on where we are in terms of what's required and what we expect to see over the next year?
Yes, you're absolutely correct, Heather. So EFRAC received multiple questions on these topics, especially from lessor side. And we know they were considering the topic, just, is there any explanation needed or update to the guidance? We hope that they're going to issue that FAQ last year, but because of a complexity, they decided to postpone it to 2025. And so we urge everybody to look for this guidance in 2025 until it's issued, because there is some judgment. Other approaches may be acceptable, some industry practice and things like this. But we definitely urge clients to look for this guidance and see which direction the EFRAC is going to take.
All right, I agree. And maybe the other thing I would add for listeners is I think Martin and I teased you a little bit with the guidance for GHG Protocol and people reporting under ISSB. So definitely, if you want to know more on that, check out our discussion in SRG 7. And in addition, I think if you want to understand better some of these implications for lessors under ESRS, there's also both for lessees and lessors, there's some discussion in the SRG, just in case you want to know more. So, all right. So definitely a lot of judgment there, and one that I think will be important for companies to discuss among themselves and with those charged with governance to the extent applicable. But let's move on, because I know another area where we've been getting a lot of questions, again, under ESRS, is how you report emissions associated with investment entities. So what challenges are we seeing there?
Yes. Again, very good question, Heather. The unique nature of the challenges there is a very specific accounting model for investments that is available to investment entities. So upon meeting certain conditions, IFRS 10 and ISC 46 allows investment entities to a certain exception to the general consolidation rules. So irrespective of size of investment or size of a percentage of their holding in investee, they don't have to consolidate their investments. They can report them as a one line item and measure this on a fair value, right? So again, irrespective of size of their interests. Which, yes.
No, I just, before you go on, because I think you're going to start to get into that counting. And for our listeners that are very familiar with these models, you're probably thinking ASC 46. That's not exactly right, but it's ASC 946. Yes. Right. So I just want to make sure for those listeners, that we got that right. So anyway, I'm sorry. Yeah. All right. So go on.
Yes, obviously 946. So based on this accounting model, investment entities get exception from general consolidation rules, and they don't have to consolidate those investees. report them as a one-line item, and measure on based on fair value. So that again, even if an investment entity holds controlling interest. So question arises, how do we consider this in a two-step ESRS model? The first one is theoretically fully consolidated group, then operational control, fully consolidated people, it's equating to financial control. So how we do this in this
because there's like in between, right?
In between, exactly. Yeah. So our interpretation of this issue that because of ESRS E1 paragraphs 46 and 50 specifically say that unconsolidated subsidiaries are not part of consolidated group, right? And companies have to assess operational control. Therefore, we think that under the first step of the assessment, it does not have to be included. So companies still have to, investment entities still have to assess whether they hold operational control over those investments. Obviously, depending on facts and circumstances, that might differ. As a general principle, and we have it published in our SRG Chapter 7, we make we conclude that operational control is oftentimes equated to what we call boots on the ground approach. So party that actually actively operates an asset or entity has operational control. It's more complex assessment.
More complex.
Yeah, you have to consider, especially in this situation, right? You have to consider existing contractual arrangements, especially where arrangements where financial interests might differ from some operational type of arrangement. So generally, companies will have to assess those arrangements. But typical practice for investment entities, they're more interested in more strategic control over investments, not operational. They oftentimes don't get involved in operational matters of a company. So we would expect that oftentimes they would also conclude they don't have operational control. Again, I just want to make sure I don't make any broad statements here. Arrangements have to be assessed because in places like private equity, that might be different because in various private equity type of arrangements, actually PEs are actively managing the companies. So it has to be assessed. So, but you can see how kind of a challenging it is for those entities, especially historically, a lot of these arrangements were reported and voluntarily reported as a Scope 3 Category 15.
Yeah. So Marcin, so just to reiterate then, so in step 1, they're out. We believe it's supportable to say they're out because they're unconsolidated. They're not in the consolidated group. And then in step 2, you need to make this assessment of whether or not you have operational control. If you conclude you do not have operational control, then you would continue to report under Scope 3 Category 15. If you conclude you do have operational control, then you would report your proportion. Well, it's
100%.
Yeah, of the
investee Scope 1, 2, and 3 emissions.
Exactly. Yeah. So just to be clear, though, if you don't have operational control, you still do need to continue to report Scope 3 Category 15. I think the question can come in is on Scope 1 and 2.
Yeah.
Okay. Perfect. All right. So definitely another area of judgment. I think this is a really good answer, though, for a lot of investment entities, notwithstanding the fact I think it would have been nice to not have to do this operational control assessment. But as you pointed out, this is a very important part of the evaluation. Okay. So let's move on. And again, I promised at the beginning, we're jumping around a little. So we're going to jump all the way to Scope 3 measurement. And one of the things we've talked about in past episodes is the fact that within Scope 3, you then have 15 categories. And, we also have 7 gases. So it's multiplying very quickly all the different things we need to measure. And one of the questions that comes up is how do you measure in each of those categories? And that's where we have this concept of a minimum boundary. So I know we were talking about organizational boundaries before. Now we're talking about minimum boundaries. So can you explain what we mean when we say that?
Yeah. Again, great question. And just one extra kind of a side comment. Scope 3 generally is an area where we start getting a lot of questions, right? Because of a complexity, because of the guidance, complexity of the nature of calculation methodology. So, and a minimum boundary is one of the first questions start getting. So let me maybe back up a little bit. So as you mentioned, GHG Scope 3 standard requires reporting of Scope 3 emissions disaggregated by 15 distinct categories. So These categories were implemented to reflect the nature of underlying activities, emission-generating activities, and just help clients properly categorize that and measure and report those emissions. As you mentioned, Protocol also implements the concept of minimum boundary, right? Minimum boundary it's very important concept because when you think about it, Scope 3 emissions or emissions in a value chain, upstream and downstream. When you start thinking about value chain of our clients or reporting entity, it could be vast, could be very complex and almost ad infinitum, right? So the first kind of when Protocol introduced the concept of minimum boundary, first they wanted reporting entities to focus on activities and value chain partners that actually matter and contribute the most to each Scope 3 category. And then they wanted to ensure that the companies are not going exactly ad infinitum, chasing down the emissions of remote value partners or activities, down the value chain. So that was the main goal, just to put some boundaries around it, make it manageable for a client, but also ensure consistency. So they prescribe what has to be measured and how, and that is one of the ways to ensure consistency, how everybody's is capturing this data. So this data could be compared. It is comparable across different companies reporting those emissions.
Okay, so Marcin, I think that's really helpful. Can you just give some examples then of what we see when we have these minimum boundaries? And also then what does the company do if they want to report more information?
Yes, so as I mentioned, the minimum boundary is established for every single category and they might be different. And I kind of consider them in group. There are some categories that have like category from 1 to 3 that require companies to report all upstream emissions it's called cradle to gate basis. So you have to capture all upstream emissions associated with production, transportation and extraction of capital goods, other purchased goods that you have. So it's kind of a all upstream cradle to gate. Then in other categories, like categories of requiring category 4, which is transportation, upstream transportation, require only reporting Scope 1 and 2 of value chain partners. So it's a significant difference what that boundary represents. The same category 15, right? You require to report Scope 1 and 2 emissions or your share of Scope 1 and 2 emissions of your investment, and Scope 3 if they're significant to the overall kind of emission profile of that investment. So you can see there's a vast differences. You mentioned what else they can report. So Protocol also established what's called optional categories. So minimum boundary is something that companies have to report absolutely. If category is determined to be material, you have to capture emissions within that minimum boundary. But Protocol lists some optional categories that companies can choose to report. Let's say, for example, category 4, you have to report Scope 1 emissions associated of your value chain partner, which is like emissions incurred during transporting of your goods, so combustion, if this is a combustion vehicle. But optionally, you can report also emissions associated with production of the vehicles that are used to transport. So again, each category has its own minimum boundary and optional reporting categories. Use optional activities, right?
Yes.
They have to include. I think it's very important to fully understand that because it makes huge difference how we look at every category. Right?
Yes. And I mean, there's a huge amount of information you mentioned the Scope 3 standard. If you go into the Scope 3 standard, they have tables of these activities and then they have descriptions and otherwise. So a lot of information there. And I know I said this was all about ESRS, but let's stick with the GHG protocol for another moment because this then is the foundation for what we're going to talk about for minimum boundaries for ESRS. Marcin, you very notably mentioned categories 1 through 3, which are the cradle to gate. And then you also mentioned, I think you used 4 to 14. Maybe you just said some other categories.
I just gave example of 4.
Okay, right? You just gave example of 4. However, we talked about category 15 investments we've mentioned a few times in this episode. And there are some unique considerations for category 15. And this is a category that applies to many companies, not just financial institutions, even though, I think often it's thought of in that context. So what can you share specifically about Scope 3 Category 15 investments?
So as I mentioned, it's an interesting category because it actually has what I call two levels of minimum boundary, right? So as I mentioned, that companies have to report their share of Scope 1 and 2 emissions of investments and Scope 3 if significant material. But there is another level of what I call a boundary. Scope 3 standards specifically prescribe what type of investments have to be, included in reporting boundary. And it limits this type of investments or asset classes, you can name it one way or the other, only to 3 types. So it's equity investments, debt investments with known use of proceeds, and project finance. So those are only 3 classes or categories of investments that you have to collect and report emission information.
All right, very helpful. And so, Marcin, I know that we often get questions then about PCAF. Mm-hmm. And PCAF, for our listeners, that probably those who need to know what it is do know what it is, but this is a partnership for carbon accounting financials. And this was put together by financial institutions to measure many asset categories, not just the 3 you talked about in the minimum boundary. And so I have this guidance out there, this PCAF guidance that is built on GHG Protocol, which means that the GHG Protocol has looked at it and said it's consistent with its standards. So then am I also supposed to follow this other guidance? So
first of all, thank you very much for fully explaining the PCAF. I always make mistake when I try to fully name the I'm used to just saying PCAF.
Yes.
So maybe let me step back. So as I mentioned, like Scope 3 standard only requires 3 categories, which when you think about it, probably those are most common categories across various type of industries, with exception of financial industry, right? Because when you look at a financial industry, whether we're talking about banks, private equity firms, hedge funds, even insurance companies, right? Their portfolio of investments, it's usually much broader, more complex. They have different asset classes that are not captured by those 3 type of investments. So that's why industry led that initiative and created their own standards to report emissions for reporting of GHG emissions for financial industry, in which they try to capture the asset classes that are most common among the various financial institutions. So as you can imagine, there's more asset classes than the 3. There's actually 7. It includes some additional classes like, mortgages or, motor vehicle loans, and others that are prevalent in financial industries. And that standard provides the measurement and reporting guidance for those extra classes. As you mentioned, GHG Protocol reviewed that and approved that, which means if you report in compliance with PCAF, it means you're also compliant with Scope 3 standards. But application of PCAF is not required to be compliant with Scope 3 standards. What does it mean? PCAF did not change the scope of reporting of Scope 3 standards, in our opinion. Therefore, the minimum boundaries outlined in Scope 3 standards are the only kind of a requirement to reporting requirements to be compliant with Scope 3 standards. So again, key point is PCAF does not change the scope of and minimum boundaries of Scope 3 standards, in our opinion.
Completely agree. And I think that one thing that's very interesting is, again, if you dig into PCAF a bit, is that it was actually designed so companies could also adopt PCAF standard. And so then you would say that you're reporting in accordance with the GHG Protocol and the PCAF standard. And so to your point, it was never intended to be sort of part of the GHG Protocol. And the reason that I think it's important to spend so much time on this, well, 2 reasons. One is obviously so people who are reporting under the GHG Protocol know the answers to this, but also this is going to become very important when we start to talk about ESRS. All right, so let's move to ESRS. And let's talk about the guidance in ESRS and how you would think about this concept of minimum boundaries when you're reporting in accordance with ESRS.
So ESRS, obviously reporting of Scope 1, 2, and 3 emissions is outlined, or reporting requirements are outlined ESRS E1-6. and respective application requirement pieces, parts of E1. It's a very interesting question because ESRS E1 basically does not provide too much kind of a details as to how to report or measure, especially Scope 3 emissions. What it does, it requires reporting entities to consider Scope 3 standard and PCAF for financial institutions, right? It also says that companies should report emissions based on 15 categories outlined in GHG Protocol's Scope 3 standard, and those categories should be consistent with this standard, which we interpret that the consistent part means that it means that determines how the category should be defined, including the minimum boundaries. So again, it's our judgment in this area, but there's nothing else that you can go by. And the only additional guidance that ESRS provides, it explicitly requires companies to disclose what boundaries they consider for the purpose of determination and reporting of Scope 3.
Yeah, it's interesting. You referenced the guidance here, and this should be consistent. And I think people who use these standards know that should is must in this context. And there is in ESRS E1, this paragraph AR46 goes through all the measurement and disclosure for Scope 3 emissions, including multiple references then to the Scope 3 standard and to the Scope 3 standard categories. And we believe when we look at those requirements, then that does refer specifically to using those minimum boundaries. So for compliance with ESRS E1, and this is actually disclosure requirement E16, we believe this is what you would do. You follow GHG Protocol. We'll talk about financial institutions in a moment, and follow these minimum boundaries. However, like there's always a however, then you also need to take a step back and look broadly in accordance with the ESRS framework and say, okay, do I have to make entity-specific disclosures? So do you want me to give a quick definition?
Yes.
Okay. All right. So ESRS 1, paragraph 11, does require companies to add these entity-specific disclosures when a material matter is not covered or not covered with sufficient granularity by one of the ESRSs. And that could be topical ESRS, the sector ESRS when they come. And I think it's this with sufficient granularity where the question comes, because if you, in your double materiality assessment, conclude, oh, I have this material source of emissions, oh, but look, it's not in the minimum boundary. Well, then that means there wasn't sufficient granularity there. So then what does that mean in the context of this reporting?
So basically, because of this entity-specific guidance, we believe companies should potentially might be required to report those. If they go through the materiality assessment and conclude that truly some emissions activity or source which is outside of a minimum boundary, therefore outside of reporting of under E16, they might potentially consider this for measurement and reporting. Obviously, the information needs to meet the quality criteria of ESRS 1. So then it has to be measured using methodologies which are sufficiently reliable, right? It must be comparable with other industry participants. But assuming that it can be done, then companies might be required to report those emissions.
So, Marcin, one thing I want to pick up on here and to help our listeners is I was very clear that ESRS 1, paragraph 11 requires an entity to provide these entity-specific disclosures when a material matter is not covered or not covered with sufficient granularity by an ESRS. You were very careful to say you may need to make entity-specific disclosures in the area of emissions. And the key reason for that difference is the may comes in because it depends on whether or not you're going to apply, the company is applying transitional provisions that are also provided in ESRS 1. So it gets complicated quickly, but you want to quickly walk through those transitional provisions and some of the considerations.
Yes, so that's the very reason why I say may, because ESRS 1, specifically paragraph 133B, provides the transition provision for entity-specific disclosures. So companies are are not required to report entity-specific disclosures if they qualify for those provisions for the first 3 years of reporting. So it's very important provision, requires judgment, how companies think about it. But we believe that companies can qualify and use those transition provisions to kind of postpone their reporting of entity-specific information.
Yeah, and I think not to get too much in the detail because people can refer to our the SRG 7, which we keep referring to, for more information. But the key question here, and why we're just saying it's could be a matter of judgment of whether or not the transitional relief applies, is because of the exact wording of this transitional relief that says it is available. It can be applied to value chain related information, except not value chain related data points that are derived from other EU legislation. And so then I think that's where some of the judgment comes in of how these requirements of E16 and the entity specific disclosures interact.
Yeah, and because exactly this, the list of all these other data points derived from other EU legislation specifically mentions ESRS E16 gross scope 1, 2, and 3 emissions. So there are potentially two interpretations to this. One is it specifically precludes application of this to just E16 reporting, or precludes it application of this provision to scope 3, right? And that's very important distinction because when you look at E16, we interpret that data points covered by E16 scope 3 minimum boundary requirement. So anything within the minimum boundary scope 3, you cannot apply this provision. But because of a entity-specific disclosure, or by definition, as we mentioned before, outside of E16, we believe that the companies can use it. But there's alternative view that says no, because this, except for applies to just scope 3, this is all scope 3. Therefore, you have to start reporting this in year 1.
All right. So that's the first judgment. And again, we are comfortable that it can be applied in this circumstance, but there are two views. Now, let's go to the second question, because what we also hear from companies is that, well, can I still take this transitional relief if I have the information available? Because when you look at the broader context of the transitional relief for value chain information, it talks about the fact that it's intended to allow companies time to gather information. So how do you think about that?
Yeah, so I would agree that in general, all these transitional provisions were, a lot of those were designed to allow people, give some reliefs if they don't have information. However, 133B is slightly different because it does not mention the availability of information at all. And when we compare it to other, we think that this is, or we believe that this is distinct difference, right? Therefore, our interpretation of this provision relief is you can use it irrespective of whether you have partial information or don't have information at all, because
or even all the information.
Even all the information. It's your choice. You have this availability to exclude it from your reporting for the first 3 years. And we think that it's supportable by the fact that 133B does not mention availability of information, while other transition provisions specifically mention those. So
even 133A, so 133B is metrics, 133A is policies, actions, and targets. Policies, actions, and targets, you need to disclose the information you have available. It's very specific. And then all of this is supported in the implementation guidance issued by EFRAG. Yes. Exactly. But nonetheless, there is some judgment there. So now you've made two judgments. Well, really three. You applied the minimum boundaries, and then you concluded that the information, entity-specific information, is outside the minimum boundaries. And then now you also have to conclude on information availability. So given all of those options that I'll say, can you summarize what this really means? Because this is not this is going to end, this transition relief, even if you take it. So if I'm a company reporting, how do I think about this in, what this means?
Well, so I think the overarching comment is, first of all, we believe there are two acceptable approaches, and difference between them is that essentially timing, when you might be required to report some of this information. And the difference between them is also whether you conclude that these transition provisions are applicable or not. So approach number one, when you conclude you're not going to use or you cannot use the transitional provision, which means starting year one, you have to report scope 3 emissions information based on E16 requirements, which means all the emissions included in minimum boundary, and also entity-specific disclosures for other types of activities that you consider material and have to measure scope 3 emissions. So year one, in both cases, you start reporting those emissions. Approach number two is when you conclude that you can apply the transition provision, which means that for E16 disclosure, you still have to report in year one. However, for entity specific, so all the other activities outside of a minimum boundary, you have until year 4. So you have to start reporting no later than year 4. So years 1 and 3, you don't have to provide this information. We believe that probably approach 1 gives more information or is more meaningful during the first 3 years. But we also believe that approach 2 is fully supportable. So companies can choose between the two. Obviously, you still have to provide the disclosure. I was mentioning before, ESRS have very specific disclosure requirements about boundaries. So you have to disclose what is included in your reporting, what you excluded, but you have ability to get more time if you chose the approach number 2.
Yeah, and I think that more time margin actually has 2 benefits here.
Mm-hmm.
One is because we didn't get into that too much on this podcast, but a lot of companies either haven't been fully reporting scope 3 emissions. If they are reporting scope 3, they're probably following the minimum boundaries. Maybe they're only reporting for a few categories. But, with 3 more years, first of all, it gives you more time to refine your methodologies, to get the data, but also provides time for maybe more measurement guidance in certain places, or just more coalescing around what approaches will be taken. So again, I think more information is normally helpful. So we do think that approach 1 will provide meaningful information, but approach 2 is fully supportable.
Yeah.
Now, there is one more judgment that we need to talk about for category 15, specifically for financial institutions. And this goes all the way rewinding back to our discussion at PCAF when we were talking about that for the GHG protocol. And then as well, when you laid out the guidance for reporting emissions under ESRS, where you said you have to consider the provisions and principles of the GHG protocol. And for financial institutions, consider PCAF. So what do we think PCAF means in the context of minimum boundaries for category 15 for financial institutions?
Well, so that's another area that gives me a headache, right? Because it's literally, as you mentioned, standard basically say you have to consider a scope 3 standard, maybe financial institution PCAF, but it doesn't tell you how to consider this, which means in a context of our discussion about minimum boundary, we think financial institutions have 2 options there. Could conclude that the minimum boundaries that they should be using are the minimum boundaries in scope 3 standard, or they could also conclude that PCAF outlines those minimum boundaries. We believe that both approaches are acceptable. Obviously, it's all subject to entity-specific disclosures. So,
and your conclusions
that you reach on transitional provisions and so on and so forth. So, obviously, it's not perfect answer. I know people don't like it. Like people like to have a very straight answer, but we think that both approaches are acceptable because of this ambiguity in that language.
Yes, and I do think I mentioned the fact transitional provisions will provide more time. In particular, we are expecting more guidance to be issued for financial institutions, or maybe expecting is too strong, but we know there's discussions, and if with the sector specific standards. So definitely for companies that particularly are taking the approach of minimum boundaries under GHG Protocol. So only 3 asset classes instead of 7 asset classes. And there's more activities as well in the PCAF. Really need to be aware that this could evolve over time and there could be changes.
Yes. And when we will get industry specific standards, that could also clarify or suggest different solutions there.
Exactly. So Marcin, let's move off of that. I know there's some more related questions that people, there's 10 pages about this in the SRG 7, and that explain all the technical arguments if you're interested in knowing more. But let's move on to a second question we've received. This one, I think, feels more obvious, but it is a question that we're asking, so want to make sure we address it. And specifically, whether or not companies are required to report all categories of Scope 3 emissions, and then how to decide if you should include or exclude some.
So let's go back to GHG, all the way back to GHG Protocol. So GHG Protocol basically requires that a company should report all relevant categories. However, it also says that it should not exclude any significant categories. And there's a difference between the two, which I'm going to quickly explain. So what they mean by relevant, GHG Protocol outlines, it has a guidance that helps companies to determine, what category is relevant. They have this kind of a criteria or indicators that should be considered in determination of relevance of that. The first one is size, so significance, but also things like influence, level of risks, stakeholders' interests, availability of data. So it's very nicely outlined, kind of a process you have to go through to determine which categories are relevant for you. However, I just want to emphasize, it has very kind of a big qualifier that basically it does not expect you to exclude any category that is significant. So this the size criteria is pretty important there, right? So,
yeah, and I think the other thing, actually, I referenced Diana Stoltzfus earlier in the episode, and I'll reference her again because she and I had a discussion about the fact sometimes you can't look at the word and just apply your normal understanding or meaning and say, oh, influence. Okay, well, I know what influence is. I have it or I don't, because there is another level of information you need to look at. So specifically, all these criteria that you just ran through, there's more guidance in the Scope 3 standard of how they're defined, and in particular of what they mean when they say, whether or not you have influence. So again, don't just presume, oh, I know what that is. I know what risk is. I know what influence is, because you need to actually go through and do this evaluation. And to your point, if you're using these criteria and trying to justify excluding significant emissions, well, you're caught by this overall requirement that you have to include all of them.
That I strongly believe that. In general, this whole process of assessing relevance is really important because it's used also for screening. So when you can imagine you are reporting entity and you never reported Scope 3, now you have to decide what and how to report. So Scope 3 includes the whole screening process, how to go and determine which category is significant, which category is relevant, what tools to use to actually do, because at the beginning, especially significant criteria, you never calculate that. So how do you do this? So it's very interesting. They point to different techniques and methodologies how to do this, to do what they call screening and determine as a starting point which of these categories might be relevant and significant that would require capturing data and measuring it.
All right. So, Marcin, we promised that this episode is focused on ESRS. We just spent time talking about the GHG protocol, and I think it's important because, again, this creates some foundation for ESRS. But what guidance do we see? There is some specific guidance on this in ESRS. So what does it say?
Yes. So ESRS E1 has a very specific guidance that requires companies first screen to determine significant categories to be reported, and specifically refers back to Scope 3 standard, even quoting specific pages with that guidance I was just talking about, for the process, how to screen, how to determine relevance, and how to determine what is significant in using words of ESRS E16 for inclusion in measurement and reporting of those emissions. So that's why I started with GHG Protocol, because oftentimes the standard refers just broadly Scope 3 to Scope 3 standard, but in this case, it even quotes specific pages where to look for, and those pages have those relevance criteria and methodologies, how to screen, what to use to determine what's significant and relevant for the company.
Yeah, and I think it's very important then for companies to recognize that when you're preparing, the overall requirement is total Scope 3 emissions, or even gross, I think, gross Scope 3 emissions. However, this is those significant categories. It's not your significant categories plus all these other small amounts. It's that you do the screening, you identify your significant categories, and those are the ones that you disclose. And since this is year one, I don't think we need to get into it, but there's even some guidance of how often you need to do the screening and how often you have to update your categories. So at least here is a place where it's this identification of categories is not something you have to do every year, unless, of course, you have significant changes to your business.
Yeah, and you're very correct. Because people like ask these questions because when you look at the ESRS one, there's even specific tabular forms that list all the 15 categories. And even in that disclosure requirements, on top, it says significant. And EFRA clarified this on, one or two occasions, which said, if something is not applicable, you just don't fill it out. Because a lot of our clients thought, oh, there's a table, I have to fill it out. Yes. And it lists all 15. Do I have to do all 15? No, it's important that even that table says, I think it's AR48, says you have to just include the significant categories. And if something is not significant, you simply do not fill out the box.
Yes. So definitely, I think that is helpful because, again, anyone who followed this entire conversation knows there's already so much work involved to, let's focus in on what's most important here and these significant ones. All right. So Martin, let's try to squeeze in one more topic here for today. And then I guess, might have to do a follow-on episode with some other questions. But I want to move off of E16, still sticking in ESRS. And now I'm going to talk about targets. So if my memory is correct, this would be an E14. And so can you give us the requirement for targets? And then we can talk a bit about why there are some questions.
Yes. So let's start. ESRS does not require companies to establish targets. That's a very, I always foundational, right?
Yeah.
However, right, if companies do have any emission reduction targets, they have to be disclosed based on requirements of ESRS E14. And E14 requires companies to disclose gross absolute targets, right, excluding any carbon offsets, any reductions or anything like that, and it has to be absolute. However, if company also have the intensity target, it also has to be disclosed. The interesting element that in this area is some companies might only have intensity target. ESRS is pretty clear there too. That requires if you only have intensity target, you also have to disclose absolute value of this target, it's a very interesting concept for me because when you start reporting progress toward achievement of intensity target, you might be showing that you're achieving it, decreasing the intensity of emissions, while on absolute basis, you might be going the other way around. And ESRS recognizes that. Nevertheless, they still require companies to disclose that absolute gross target.
Well, I think that's why they require. Yeah. And I guess just quickly for our listeners who maybe are less focused on this. So an intensity target, you are basically saying, here's my amount of emissions as, based on revenue. So the amount of emissions per dollar of revenue or for some other financial statement metric versus, to your point, an absolute metric is just
emission.
Yeah, just the amount of emissions you have. So if your revenues are going up and your emissions are going up at a slower pace, your intensity is going down. But again, to your point, your absolute amount be going up and in this case, they want you to show it because that's what's probably the most important here. So I do think for companies that have historically reported intensity-based metrics, it's interesting because you said, well, it doesn't require you to establish a target, but yet I do have to convert my intensity target into an absolute target. And I think some companies have had a struggle with that. And we do have a small transitional relief that has come up in one of the FREG Q&As that maybe we should, is at least talking about because it could provide, again, it's a very small amount of relief, but at least it's a bit of relief.
Yeah, so the question was raised to multiple questions were raised to EFRAG, especially from financial institutions in a context of having intensity target for scope 3 category 15 for the portfolio companies or investments in there, which is very popular in finance industry. A lot of the companies have intensity targets there. For them, converting this intensity target to absolute value it's challenging because it requires additional information from portfolio companies they may not have, right? So, and it's like in my simple mind, it should be very easy, but when you start digging into the specifics of this case. Therefore, that's why they asked these specific questions. So EFRAC responded that they recognize there might be some challenges there, but they still say standard is pretty clear. You have to show that. However, they pointed to ESRS 1 paragraph 133A that gives the relief, right, for a certain value chain information. So they say this absolute value would be value chain information, and you can get a relief based on the 133A, so you don't have to present it for first few years.
Yeah, and I think what's key here, and sorry to use so much references to the standards in this podcast, it's very specific, but it's important. So earlier, Marcin and I were talking about ESRS 1, paragraph 133B.
Yes.
And there's no information requirement, as we said. ESRS 1, 133A, as we mentioned earlier, does have an information qualifier. So this transitional relief can be applied, but if you have the information for your target, you would need to make the disclosure. So you cannot apply the relief if you have the information available to you in-house.
And EFRAC was pretty clear when they commented in that. They said whatever information you have in-house, you report, but if you don't have it in-house, you can apply to provision. Very good, Heather. I just totally forgot about that, to be honest. And I think it's very important.
It's extremely important.
And they emphasized that in their answer.
They did. Now, the one other thing that we have talked quite a bit about is that the answer was given in the context of Scope 3 Category 15. It obviously only applies to Scope 3 because it's value chain. So if you have targets related to Scope 1 and 2, you need to do these conversions from year one. But we actually do believe that this transitional relief would equally apply to other categories to the extent applicable. Now, if it's, for some other categories, maybe you would already have the information in-house, so you would need to consider that aspect of the provision.
Yeah, I agree. I mean, there's no reason why other categories could not be applied. They specifically address category 15 because it's fairly big issue for financial institutions. And those are the ones who ask the questions. But if others have lacked the information for conversion of that to absolute value, they could apply the same provision.
All right. So, Marcin, I have actually several more questions for you, but we are at almost 1 hour, and that's probably the maximum anyone needs for GHG at any one time, including us. So maybe, who knows, to our listeners, we might have another bonus episode. But just as always, such a pleasure to talk to you, and thanks so much for joining me today.
Thank you very much.
All right. And then to the listeners or viewers, potentially, if you're viewing our video podcast, thank you as well for joining us today. And I do highly encourage you to check out the other episodes in this video podcast series, whether that's listening on your favorite app, or you can find the links to the videos on some apps and as well in Viewpoint. And then in addition, as I said, who knows, look for another bonus episode or potentially another a video podcast series. But once again, thank you. That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.